Hello, everyone. Welcome back. So, I appreciate you all giving me a week off. I was off to London on business, and I'll be back there in about 10 days. So, lots going on. Had some really exciting meetings. Met with some really interesting people, and everything is really moving in the right direction. So, it's fantastic to be able to work with people. The one drawdown about London is great for business if you need to do business, but the one drawdown about London is it is almost impossible to ever see the sun directly. So it doesn't matter how much color you go there with, you're going to come out white. It's just part of the deal, which is a little sad, and it's, cold. It is incredibly cold. So, yeah, it's unfortunate, but part of the deal. Anyways, well, with that being said, I want to thank you all for being here. Thank you all for coming back. This class is on price action trading. We had, and yes, if there are problems with the sound, just relog back in and see how that works. Trading Trader says, have you been on the big wheel? No. The funny thing is I've been to London many times, but I know almost nothing about the city. And everybody's like, well, wait a minute, you've been here for a while, you've been doing this, how do you know nothing about the city? The thing is when I'm going to London, I'm there always on business. I don't go there I just haven't been there for fun or vacation or anything like that. And when I'm there, I'm in meetings anywhere that start anywhere from 8 and 10 in the morning and go till 6, 8 o'clock at night. And so I don't have the time to see London really for much fun except for past 8 o'clock at night. So there's so much of London I haven't seen. I haven't even seen the River Thames, and I barely know the city. People are like, this district, that district, and I'm like, where is that? As long as the cab can get me there, that's all I need to know. But the funny thing is I spend most of my time in hotels and in meeting rooms, basically. So take extra days there. Yeah, that's not really an option right now. In the future, maybe later this summer. And if I'm going to take extra days in London, I'm going to want it to be warm. Because London is bloody cold. They're like, oh yeah, we're going to have a high temperature of 8 degrees today. And I'm like, that's like 4 degrees, it's barely 4 degrees higher than the coldest temperature we'll ever see in Argentina, in Buenos Aires. So, go in the summer is the plan. But so I actually know very little of London. And I have very little time there. But, so not last week, we didn't do a class, but the week before that. And we had a very, I guess you can say, passionate and vigorous talk. And I'm not sure if the person who was in that, who was kind of the main proponent of the other side of it, we were talking about, support and resistance zones, supply and demand zones, and that those are really, they were saying that's the only thing, that you really need to learn to figure out how to trade price action. They were saying that's what causes all price action. I forget who that was. Does anybody remember who that was? Maybe you're here today. If you are, please announce yourself. So, but the main person that was behind it doesn't look like they are here. Maybe I scared them away. But who was here for that discussion? And on another note, who is here for the first time? Was it Dry Desert? Really? I didn't think it. Maybe it was Dry Desert. I can't remember. Yep. Okay. Not sure. First time. Okay, so we have first time. Georgia the first time. Capre tires, first time. Harley says, but it got obnoxious. Well, maybe. That often happens when people are very passionate about their position. If they can take that too far, then it tends to become a part of their personal territory that they're defending, but it also becomes one of those things where they really don't have an open mind. And that doesn't really help for anything. There's no progress without an open mind. Believe it or not, some of the more open-minded people I find to be out there are scientists to some degree. There are many scientists in the field that were shown a new version of mathematics or shown a new version of, some sort of structure for the universe, and they looked at their old methods and said, you know what, this makes sense. I have to abandon this. I was wrong, and they do, and they give it up. And that's something, that is a very useful thing. That when people, really realize that the mountain of evidence points in another direction, that they're able to just abandon their position and try and find it instead of trying to find other angles to attack the opposition. It's important that in this market we have an understanding that there is not a monopoly on the best way to trade. I actually spent a lot of time in London meeting with a combination of, I met with one of the largest financial advisors in South Africa. I met with one of the most successful and largest currency trading funds out there, the head of that team. I met with a former bank trader for Barclays, Royal Bank of Scotland, and Bank of York. And one of the things we all talked about is that we all said the same thing, which is that there is no one why as to why the market moves. It's not fundamentals that moves the market. It's not technicals. And it's not Fibonacci's that just move the market and nothing else. It's not just pivot points. It's not just this that move the markets. There are so many whys. Everybody has a why. All the professional traders and institutions out there have whys. Their own whys. And those are the ones that they believe work best for them for their own objectives. Now, does that mean it's a better why or a worse why than yours? No. What really matters is how does your performance work out? Is it consistent? Is it stable? Do you endure and perform well during really difficult periods and not just easy periods? So with that being said, the performance is really a determination of how well does your theory and perception of the market play itself out, and how well do you execute that. It's not just a combination of how well your theory is or perception of the market is, it's how well that your perception of the market is on the market and how well you execute it. Because you could have great perception on the market, but if you don't execute it well then the problem's not with the theory, the problem is in the execution. And so those things have to be in place. But there are so many of those that they're all buying and selling for their various reasons. There is no way for us to ever know the full why. The full why is a gestalt of all of those put together. And because they are so varied and so far on the spectrum, the bottom line is that there is no one why that we can rely upon and say, this is it. This is, the why that is the why of all markets. Because there isn't. There's so many. With that being said, we have choices then as traders. And the choices that we have as traders are to, A, find one of those perceptions on the market, those perspectives, that makes sense to us, that naturally aligns to us, that when we look at it, we think about it, and we break it down, it makes sense to us in a way that we'd say, okay, you know what, I can trade that. I think that's an interesting perspective. And so with that being said, that is one thing that we can do as traders. The other thing that we can do as traders is really try and develop our own perspective. But the bottom line is we have to take a perspective on the market. And that's what we have to trade. And it could be one of those that I listed, or it could be something that I was not listed. And, excuse me, I'm drinking lots of fluids lately. I had massive fever this weekend, and so I've been recovering from fluids. That plus a 15-hour flight from London doesn't help. But, so I might be periodically drinking throughout this. So, the thing that we have to do is pick a perspective, and one of them is what I'd like to present in these classes, and that's price action trading. But the perspective that the way that I approach price action trading is a little bit different than the way other people approach price action trading. Sam Seiden has one way to approach price action trading. He uses supply and demand zones to do that. And I find that useful as a perspective, but in my opinion, and this is just my opinion, this is just my take on it, I think learning pure price action first would be more valuable than learning supply and demand zones first. And I had listed some of those reasons why in the last class. I had some time to really think about it even further because it was such an engaging discussion. I really wanted to kind of think about it a little bit further and come up, challenge my own position, try and have an open mind about, see what else I came up with. And some of the things I came up with is, well, where are the previous supply and demand zones to relate to when a market is making all-time new highs or all-time new lows? They don't exist. What about silver? Silver right now for the last few days has been making all-time new highs. How do we find supply and demand zones if they've never been there before? A lot of this person's argument, I think it was Dry Desert, had said, well, where previous buy and sell orders had congregated and things like that, and he went over it. And I'm like, well, the bottom line is that there are times where markets could be making new highs or new lows. They don't exist. There are no previous areas. What happens when there are no previous areas? Then what do you do? What happens if the market is making a new high and just keeps making new highs? A pure price action trader is going to be able to take advantage of that environment. Round numbers, they're pretty far in between. There's a pretty big difference between 140 and 141. Wait for a retracement. Great. These are all options. But guess what? They're all options that require you to wait. And not all trading opportunities will be around round numbers, will be around a fib extension or a fib retracement or semi-round numbers. There are tons of trading opportunities at every single price level. If my signal says get in at 138.13, I'm not going to sit there and say, well, guess what? It's not here, it's not there, it's not this and this, so I can't take it. No. If the trading opportunity is there, the trading opportunity is at that price. And so the bottom line is that when a market is making new highs and continues to make new highs and is way beyond any level ever seen in its history, aka silver or dollar Swiss recently or gold and all these others, well then those supply and demand zones don't exist. Because there is no place that we have that. We have to wait for them to develop, which means we become a passive trader. And the one thing you don't ever want to be is a passive trader in the market, just waiting for these things to happen so that you can kind of take what you want. If you only want to be that kind of trader, fine, you're welcome to do that. But you will be paralyzed in certain environments. There will be certain environments where you will not be able to trade because your supply and demand zones don't exist. And I never want to be in that position. I never want to be in a position that I'm paralyzed to trade. So, with that being said, that is why I feel price action, this is just some of the reasons why I feel price action, I don't want to say it's superior, I just want to say it's something that you would want to learn first. I believe you'd want to learn first because if you do learn how to trade pure price action, then regardless of whether you are at a supply or demand zone, regardless of whether you are at a fib retracement or not, a round number, a semi-round number, previous areas, any of those, you will understand how to trade it because you'll understand what the price action is communicating to you. Now, if you take the traditional method, well, it's actually not the traditional. It's actually kind of like the neo price action method. The neo price action method really evolved into trading candlesticks and waves and, certain formations, triangles, head and shoulders, funny geometric things. And the funny thing about it is that it got us trading structure and not trading the causes and the things which create pure price action. What creates pure price action is order flow, the total summation of buying and sell orders. The only two facts you have to work with in the market, the only two, are A, that as long as there are buy and sell orders, the market will move, and B, the total summation of those orders, and that includes the amount of volume of orders and number of orders and where they are positioned long or short side. The total summation of those is what will cause the market to move in the direction that it does at the rate that it does. Those are the only two facts of the market that we have to work on. And so there are ways that we can glean that information by looking at the price action. Why is that? Because the price action is a pure product of that. It's a pure product of all of the order flows, all of the orders, all of the buy and sell orders. And so with that being said, I don't generally recommend the neo price action movement, which is out there right now, which is trade this, formation, trade this and this and this, trading pure structure. Because the whole point is we want to be understanding what the price action is communicating about the order flow that had created that kind of price action. And once we can understand the order flow behind it and how that order flow was created over time, which is not as difficult as you think, well, then we can really understand pure price action. And then once we can really understand pure price action, from that point, then we can really start to trade pure price action. That's the perspective that I teach. That's what I'm going to be teaching in these classes. For those of you who knew, we had a lot of new people in here. You also weren't possibly at that last class. That's what we're going to be covering, or we're going to be going through some of those things today. So let me take a sip, and then let's talk about some of the things, these questions that you had. Okay. So, Biz says FX Concepts. For their own personal reasons, because I'm going to be working with this trading fund very closely, I don't want to mention their name. Until the contract and everything is signed, I don't want to mention anybody's name about who I was talking with. But in case you don't know, FX Concepts is the largest currency fund out there, well over $13 billion. They've been in it for quite a long time, have a pretty solid, stable track record. Just an excellent outfit. Anybody that gets to work with them is, certainly blessed. But until the contract's signed, I don't want to mention anything, and I'd like to keep that on the down low for right now. Trying Trader says, does good execution come with practice? Usually, yes. If the practice is focused and dedicated, there's a lot of information about this, about dedicated practice, but this dedicated practice really came out of the Anders Ericsson study. And so, if you're practicing with certain goals in mind, certain targets, certain things that you want to learn, and a certain passion for what you're doing, then you're really putting all your energy in the practice, and you're really putting all your energy into learning whatever it is you're doing. And so if you really practice a lot, and you practice really passionately and dedicated, and you're focused, and you have goals and everything, then that usually leads to good execution. However, I may swing a golf club 1,000 times, but if I'm thinking about my bills and business and, the girl that I met at the dance club the other night and all these things, well, with that being said, good execution won't follow. So practice alone isn't going to do it. It's the way you practice that will do it. If you practice really efficiently, really well, really intelligently, really focused, then good execution just naturally follows. If you really want to try this out, try and learn a precision sport like pool or golf or archery. I'm learning archery right now. I'm practicing archery. I've been in competitions already. And, the amount of effort and everything that I put into the practice, we're just practicing the same motion again and again and again and again. And so I could do it 1,000 times and become really good, or I can do it 1,000 times and not become that good. So it's very important that I'm really focused during that practice. But if I keep doing it, the execution will continue to get better. Okay. Okay, Tish says, one difficulty I'm finding with price action and other methods are the conflicts with other time frame charts. Do you think it would be a good idea to focus and get practice with just one time frame hourly, for example? This is an excellent question, particularly around price action. So, and this is not just something that happens in price action, but it happens usually in all systems, is that, all systems, like whatever one you're using, whether it's Ichimoku, a lot of traders would ask the same questions. They'd say, well, I get a good signal on the 4-hour chart, but I don't find one on the daily chart. So I don't take the signal, that's it. Well, here's the thing about it. Signals will test differently on different time frames. Pure price action signals will test differently on a 4-hour time frame than it will on a daily time frame. It's going to have different numbers because the time compression is going to have a different relationship to how that particular currency moves. Case in point, let's take dollar CAD. There is a very concentrated period of time that dollar CAD is moving very actively. That is when there is a lot of oil and futures contracts being traded. But the time period when that's not happening, when those markets aren't open, ergo, the Asian markets, well then dollar CAD isn't that active. In fact, it's one of the least active majors out there. So the thing about it is this, is if you have systems that are tested, that are calibrated, that are measured to work on specific time frames, then I recommend just trade in those time frames and just focus on them. Maybe it's just the 4-hour, maybe it's just the daily. In terms of trading pure price action, I wouldn't recommend trading the hourly, starting off with the hourly in the beginning, because it's much harder to do. You have less time to react, there's less data, there's a lot more noise, and the bottom line is that it doesn't quite, it's much harder to do. Signals, I've done quantitative analysis on systems that are incredibly robust on the daily and 4-hour time frames, and in the 1-hour time frame, they're just not as robust. So to trade price action in the 1-hour time frame takes a lot more skill. It's like you want to be a race car driver, but right now the fastest car you can handle is maybe a BMW. Maybe it's not even a BMW M3 or an M5. So you got to work your way up into that. And even then, even though I could handle trading, even though I personally can handle trading price action on a 1-hour time frame, I can even handle it on a 1-minute time frame. The bottom line is that I still trade on the 4 and daily time frames. It's just easier. It just makes more money. I have higher accuracy numbers, a lot less stressful, much easier to manage. So my recommendation is, yes, for now, in the beginning, focus on one time frame and find one that's easier to learn. don't find one that's really difficult to jump into. Find something that is, I would say starting off on the 4 hour. That would be a good place to start. Pretty balanced, pretty good accuracy, pretty good numbers, good price targets. Stick with that for right now. Once you get better at that, you can work on the daily, you can work on the hour. And after you've gotten good at trading all these different time frames, then you can really start to use it. But I personally am not sitting there switching. When I'm analyzing euro dollar, I'm not sitting there going, okay, let me check it on the daily, and then the 4 hour, and then the 1 hour, and then this. No. I just glance at each time frame. I say which one holds the best pattern, ness at that time frame for that pair. And then, okay, this one looks best, so I'm going to stick with this one for today. Maybe tomorrow it'll be the daily charts. Maybe tomorrow, the next day will be the 1 hour charts. Pairs have rhythms on different time frames. So with that being said, for right now, I just focus on one. Just make it a lot easier to increase your learning curve. So hopefully that helps. Okay. Okay, so Rana says, please explain trends. I need a little bit more explanation on that. It's kind of a broad-based question. And if I was just to answer that question as is, I would be here for the next 2.5, 3 hours. And that just wouldn't work. So if you can give me a more specific questions, that would be great. Irvin Barcelona, Canada, I think, has a question. How does one detect divergence by just looking at price action, no oscillators? Alos, I think you mean also, not Alos. Can you please tell us your view of order flow is when a divergence is setting up and then working? Okay, so the concept of divergence and price action, the concept of divergence really comes from indicators. It comes from RSI, MACD. It comes from all these. It comes from a very particular class or two classes of indicators called oscillators and momentum indicators. Okay? Oscillators being, say, CCI. A momentum indicator would be momentum. Another oscillator would be RSI, very famous ones, or stochastics. And they have their ways of responding to price action and previous price movements and such. And what they do is then they create this line, and those lines can be diverging in movement from the price action. They can be moving in opposite directions. They can move in the same direction, coming together. So the concept of divergence isn't actually a pure price action concept. It wasn't created until indicators. So, in the answer to your first question, how does one detect divergence by just looking at price action and no oscillators? If you're really referring to no indicators, there technically isn't a way to do that in the original definition of divergence. Now, there are price action methods you can use to determine or pick up a similar effect that those oscillators or momentum indicators would be picking up in terms of divergence. However, I can't really talk about the concept because of a very particular reason. The reason is, the answer to that is in my upcoming book, and my editor is tilling away mad, super fast. The guy finished like 3 chapters in like 3 days. It's amazing. Just amazing. Anyway, so with that being said, I can't reveal that answer in terms of how you can pick up divergence in price action until the book comes out. Otherwise, I would just be defeating the purpose of me publishing the book. So, with that being said, you're going to have to wait. It's going to have to be a couple months before you get it. But I actually go through several methods in there, and my goal is that hopefully after that book, that there are ways that people now, once they know those methods, they can start to pick up divergence. Google, yeah, I wouldn't necessarily recommend that. But there are ways to do that. Present a preview on FX Street. Yeah, there's not an easy way to present a preview without giving away the main answer. It's like I can't explain the concept without explaining the answer. So, with that being said, hopefully that answers your first question. Now, the second question is, also, can you please tell us your view of order flow? Tell us your view of order flow is when a divergence is setting up and then working. Tell us your view of order flow is when I don't understand the nature of the second question, Irvin, so if you could retype that one for me, rephrase it, that would be helpful. Okay, Harley says, I find that it takes a lot of time to get used to reading multiple time frames, but once you do, it's great. Yeah, and the easiest way to do it is break the project down into smaller chunks. So start with the particular time frame one at a time. That's the way I would do it. Okay, Trying Trader says, I agree you cannot trade the size when it's crossover and can't see the price moving, then it all makes sense. But this takes time. It took me over a solid year, and very recently it has happened to me where I can read the chart so clearly. I don't know why. Okay, good. Okay, Boyke has a question. So, do you prefer trends or ranging? Excellent question. I prefer trends more than ranging, and here's why. In a trend, the order flow, which is mostly directed by the institutional market. The institutional market is really the major sum of the order flow. The retail market is really only 3% of it. So, and by and large, we're a fly on the wall. The institutionals are what, and the biggest traders, biggest funds, are what moves the market. The institutional part of the market is what moves it. A trend is created from an order flow perspective when the order flow is heavily imbalanced on one side of the market, on the long side or the short side. And you can think of it as a sliding scale. So if you had like a straight line in front of you, and the left side was the heavy sell side, and the right side was the heaviest area of the buy side, right in the middle, there was a perfect balance between them. When that scale slips heavy to the right or heavy to the left, trends develop. It usually develops when the market starts to push above 60% to one side or 60% to the other side. That's when trends really usually start to develop. And so, with that being said, if a trend is a pretty good trend, it's usually around 60% on the buy side or 60% on the sell side, or more, 60%, 70%, 80%, 90%, whatever. What that's telling you from an order flow perspective is that the market is heavily skewed to one side, and that's where all the money's to be made. Why? Because that's where all the money's already pushing the market. So you don't have to call direction. All you need to do is the direction's already called for you. You just need to find an entry and time your entry, and that's it. And even then, timing, you can be a little bit off on that. You just have to find a good location to get it. And if you can do that, then you can make money pretty easily. It's not hard to make money in trends. In fact, it's the easiest money to be made, but it's not just the easiest. It's also the one where you have the greatest probability of making the most money. Because if the money is already pushing in that direction, then there's a chance that other people will pile into that and help push in your direction, and the same people that are already pushing in that direction are adding new positions on, and they want to keep making money. So you create an environment where the market has a good tendency to just push in one direction. And as long as you're in that direction, there's a greater probability you'll make money because of the more clear directional push. There's less of a fight on the other side. And so with that being said, I prefer trends to ranging environments because in a trending environment, I have that opportunity. It's much easier for me to make money in that than there is for range. In a range, there's the scale or the pendulum's more in the middle. And there's also usually more of a two-way interest. The two-way interest is much more balanced. the buyers and the sellers have a relatively even stake in the game. So I'm going to be forced to take a side. And I'm always going to be forced to take a side. But in that one, it makes it a little bit more difficult because neither side is that much more likely to win. The probabilities aren't heavily in one favor. So that means that you yourself are trading with lesser probabilities on your side. Now that doesn't mean there isn't money to be made in a ranging environment. The bottom line is if the market's moving, there is the possibility to make money. But the thing about it is that which environment are you more likely to make money? And I believe that is a trending environment. So I myself trade trends more than ranges. If the range is really nicely defined, it's clear, it's wide enough, then I may attack it. But 85 to 90% of my trades, trending environments. So hopefully that answers your question. Alex, and it's a great question there, Boyke. Alex has a good question, or has another question. If you prefer a more specific question, with your Euro chart, what's the trend for the next week or two? Well, okay, sure. Thanks for giving me a more specific question. That question, I'm not in the job. It's not my job to say next week or the week after, this is what the Euro is going to do. Because you know what? Nobody fucking knows that. And excuse my language, but nobody does. Maybe even a central bank has a pretty good idea. But other than that, they don't know. Even the institutional market does not know. Why? Because there are a million things that could happen which could completely blow that out of the water. Trichet could come out at any random point in time and say, hey, guess what? I'm going to raise rates, and I'm going to do it a little bit early. Well, the market would go absolutely bananas if that happened. But he's an X factor. There are so many X factors that could do that. So I don't sit there and try and say, for the next week or two, this is where the Euro is going to go. What is my job as a trader? My job as a trader is to take all the information that's on the left and then make a decision upon where it's going to go to the right. Now, do I put a timestamp on that and say next week or two? Maybe if I'm trading the daily or weekly charts, and even then, I wouldn't even say this is where I think the Euro is going to go for the next week or two. I can form opinions, but honestly, most of the people that are forming opinions about the market and then broadcasting them, they're analysts. They're not traders. Most traders don't sit there and go, yes, okay, so for the next 2 weeks, the Euro is going to do this, this, and this, and this, and I'm going to do this, and I'm going to buy here and sell. No, they're sitting there going, you know what? My system is giving me a signal. I'm going to buy. And I'm going to stay in that trade until my system says get out. Or their system might be saying, I'm going to sell. And I'm going to stay in that until I get an exit signal. That exit signal can come in 2 days, 2 weeks, 2 months, 20 decades. It doesn't matter. If they're really a professional trader and they're trading off a system and their system has clear rules, they're not spending time sitting there saying for the next 1 week, 2 weeks, 3 weeks, this is where the Euro is going to go. And if I really wanted to do that, even if this is not my job as a trader. My job as a trader is to trade and make money. It's not to decide where the Euro is going to go. My job as a trader is to have no bias in the sense of where the bias influences my decision making. My job as a trader is to just make trades, and when I get my signals, I take them, and when they tell me to get out, I get out. That's what they're designed. That's what my job is as a trader, is to make money, not to make predictions. Predictions is what analysts do, and most of them don't trade. So with that being said, there's not much I can really say about that. But even if I was to do that, I wouldn't be using the 4-hour chart to do that. I would be using probably the daily or weekly chart to do that. And even then, I would just say, you know what? I think the market is more likely to go in this direction or this direction, but at any point in time, I'm willing to completely abandon that belief or bias if the price action is communicating to me something different. A pure price action trader is always listening to price in real time. A pure price action trader has the fingers on the pulse. And just like the pulse of the market, your own pulse changes as it goes throughout the day. So with that being said, that's my answer to that question. Okay. Boyke says, I'm going to answer a few more questions, and then I'd like to take a look at Euro and maybe another pair, and we'll do some real price action analysis real time, analyze the order flow behind it. We'll go over some things to watch out for. We'll do that all in real time, and we'll try and do it in such a way that we're able to answer the questions that you guys posed here at the same time. Boyke says, I know 20 is your favorite. Would 50 be better on this chart for recent action? It's a good question. If I put up the 50, maybe it fits a little bit differently, but I generally don't find it to be a good idea to be moving average fitting as a chartist. I don't try and sit there and say, well, the 20 today is not working, so I'm going to try the 50, try the 30, and trying this, and try that. Once you go down that road, it's a slippery slope. And so it's very difficult to just say, I'm going to pick these two moving averages, and these two moving averages will be my reference points for support and resistance or turning or things like that. I recommend picking one that you feel is the best and then sticking with that, because if your reference points are always changing, it becomes very difficult to know what you're testing is true. If I'm a scientist and I'm always changing the variables of the study, I'll never have a really clear understanding if what I'm testing is valid or not, useful or not. It is only after testing it over a long period of stimuli, a large database of sorts, that I can really tell, is this robust or not? So I would suggest picking one and then working with that. Max 2, but even then, what you're going to do is as soon as you get 2, you're going to start referencing them against each other, and now you're performing a second layer analysis. Instead of just saying, this is price's response to the 20 MA, you're going to be saying, well, over here this is price's response to 20 MA, but this is price's response to the 50 MA, and then what you're going to start doing is a comparative analysis between the two. So you'll be doing 3 reference points instead of 1, even though you've only added 1 variable. You'll be comparing, well, it's not doing this to the 20, but it's doing it to the 50. So you've now compared a creation statistic there, or a contrast statistic there. So with that being said, I'd recommend just sticking with 1. That would be my thoughts on that. Okay, Jack, number 1 says, does pure price action traders use indicators? Depends on their style. I know some that use no indicators. I know some that use one indicator, maybe 2. It really depends on your style. And so with that being said, the max that I'm ever using is 1, and that's 20 MA. Sometimes I'm not using it, but I've found that using it with the 20 MA can be incredibly useful. And that may be the indicator for you to use with, and it may not be. Some people will trade price action purely with pivots, and that's it. Or purely with Fibonacci's, and that's it. So it really depends on your style. The key is that you can do it without it, and then once you've really developed that skill, then add in the 20 MA or whatever other indicator that is. So hopefully answers your question. Okay. Last 2 questions and that's it. It seems like somebody's raising a hand, but I don't know who that is. I keep getting these noises from Hakan, so it's very interesting. Anyways, last 3 questions and that's it. Luke says, what about corrective waves? What are you looking for a good entry on them? Okay, well, first off, I want to get clear on something. I don't trade price action based on Elliott wave theory. So I don't label them waves. Because once you start getting into labeling things as waves, then you're really subscribing to a bigger paradigm of price action. Not a bigger paradigm as in better, but more of like a different paradigm of price action. You're subscribing to Elliott wave theory when you do that. And I don't subscribe to Elliott wave theory. I think Elliott did a really good job at bringing out some key concepts, but I think he kind of goes off the mark after a while. Just like I thought Candlesticks did a good job of bringing out some key concepts, but I think it goes off the reservation after a little bit. I think Elliott did it. I think many of these others did that. That's just my opinion. And so I want to be very clear from the beginning, when you're talking about corrective waves, I don't subscribe to waves. I just call it a move. And by doing that, I don't subscribe to wave 1, wave 2, wave 3, and all this. I don't get into labeling all that. So if I see a corrective move in the market, that's a very different story. Now Luke says, what about let's just say corrective moves, which he then reworded it. What are you looking for on a good entry from them? It's an excellent question. Well, the first thing I want to do when I look at a corrective move is, of course, obviously properly identify that it is corrective. Once I have identified that it is corrective in nature, then what I'm usually looking for is to see if that corrective move has structure to it. Is the candles that are in that move increasing in size? Are they decreasing in size? Is it making significantly higher highs and lower lows? Or is it starting to slow down in that process? Let's take an example here. We have a very strong move inside the euro dollar here. And let's just talk about the larger move as a whole. So we have this impulsive move here, and then we have this corrective move here. Now, there is a point here where it is impulsive, but other than that, it's largely corrective in nature. One of the things I'll be looking for, well, does this have any structure to it? And it appears that there is some sort of structure, so I want to test that theory. There seems to be a relatively persistent angle in here, and the parallel angle almost matches out. Not quite. So it's not pretty enough for me, so I'm going to say, you know what, the structure isn't necessarily a channel type corrective move. So since that's not there, then what am I looking for? Well, I'm looking for what is the angle of this particular corrective move? And one way to do that is take two identical points of the price action. You can take the top or the bottom. And what I'll do is I'll take a couple relatively stable points, ideally 3, of the impulsive move, and I'll start to look at the angles of the two by putting the two lines together. And this angle is sharper than this down angle. The up angle is just sharper. So it definitely meets a corrective move. The angle, though, is pretty decent, though. If you want to get clear on angles, what you do is you fix the X and Y ratio on your chart, and then the angles will always be fixed, and therefore your angles and ratios will be proportionate. So when I see something that is a 30-degree down angle or a 30-degree up angle, that means there's a decent amount of force to it. So I'm going to have to be much more precise in choosing an entry trigger to get into that corrective move. If I believe the corrective move is going to result in a continuation of the previous trend, well, then I'm looking for another long entry. And so if the angle is pretty sharp, then I'm going to sharpen down or become more refined with my choice of reversal signals or entry signals on that one. Because really, if the larger structure is in place, you have an impulsive move, and then a corrective move to the downside, then I believe the larger structure of the impulsive move will follow up with this, and it did. And as I said that the last time, 75% of all impulsive moves are followed by corrective moves, which are often then about 70-75% of the time followed by an impulsive move in the same direction as the original impulsive move. That's exactly what happened in this one here. And I said that before this move, before this last upswing happened. This is how it works out. So what am I looking for to get back in? I'm usually looking for either a trigger candle, and those are very specific. B, I'm looking for price to relate to maybe a fib level and react to that, or a 20 EMA, or a pivot point on any particular day, but not just any pivot point. I'm usually looking for one of the outer pivot points. What do I mean by outer pivots? R2, R3, S2, S3. And the reason why I call them outer pivots is because statistically they are hit less often. They're just hit, the R2 and R3 pivots are hit a lot less often than the R1s are. It's not even close. So with that being said, I'll look for maybe a trigger signal, but sometimes I'll look for the trigger signal off of a fib, off of a 20 EMA, off of a pivot point, an outer pivot. Those are some of the things I'm looking for. One of the other things I'm looking for is possibly also for price to reestablish itself above the 20 EMA again. If it showed a history in the previous impulsive move of showing stability above the 20 EMA as it did here, 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 and then again here, well then what I'll do is I'll look for it to show again further stability above that 20 EMA as it does here and here and here. And then here, this is, if you've seen my video on my website, this is a with trend failure. So it tried to break the trend, and then it failed and started another with trend move. And then what did it do? Established a stability with the 20 EMA. So those are different options. I can't go into the specific trigger formation of the reversal signal because that is something for my price action course members only. And for those that paid for it, it would be unfair if I gave it away for free. So I apologize for that. But to give you a hint, just kind of at least some kudos about it, I usually look for a candle that is counter the corrective move. It either A, has a very large candle, or B, has a really large body that takes out several of the previous candles that were, in this case, selling. So the corrective move is selling. I would be looking for a bar that is very large in the opposite direction. That would usually indicate that the market has said, okay, this thing has pulled back enough. We feel confident the market's going to continue its upward direction again, and we're so confident about that, we're going to put a lot of money on the line. The amount of money we put on the line is a reflection of that confidence. Case in point, market has pretty solid, decent outmove, more blue candles than red. Starts a pretty decent sell from the red, but then what happens? Boom! It's bought up very aggressively. And so these are the buyers coming back in saying, you know what? We don't feel this should be selling off. In fact, we're so confident, we're going to put a lot of money into buying this. And that is a reflection of our confidence that this market is going to keep going. And what happens after that? Only 1, 2, 3, 4 out of 16. 4 out of the next 16 candles are red. So this heavy buying obviously spurred on a lot of confidence and continued buying in the market because only 16 out of the next 64 hours were selling. That means the market was being bought up at a very consistent rate. So those are some of the triggers that I look for. So hopefully that answers your question. Those are just some of the ways. There are a lot more advanced ways to do it. Okay. Last few questions, and then I got to get out of here. I also have another meeting right after this. So, Try and Trace says, Chris, until you can read a chart well, it will be difficult to build a system to trade. Yes. Is it true? Yes. In reality, yes. Because, I can understand everybody's need and want to build a system. It's totally understandable. However, if I'm going to learn to be an architect, I wouldn't start building buildings without learning how to build a foundation and, structural supports and all these other things that go into it. So it's very easy for a trader to jump ahead of themselves and say, okay, I'm going to build a system without really understanding markets. Very few architects are just building buildings. In fact, none of them are really designing buildings in their freshman year. They're going through a lot more different things on that. Many of you are probably, in reality, in your freshman or sophomore years of learning these markets. Maybe a couple of juniors in here. Probably very few seniors. But that's just a reflection of the time and effort you need to put into study and learn this market. Once you start to get really good at that and your base of knowledge and understanding the market is built up, then I would work on building a system. If you want to accelerate your learning curve, study some course material, study with a mentor, study some systems of somebody who has built several buildings, is a seasoned architect, learn from them, see what they do, and when they build buildings, and then try and take those things, learn them for yourself, and then you can start to learn how to build them yourself. That's how you can accelerate your learning curve. So hopefully that answers your question. Okay, last question, and then I got to wrap it up. Is it true that some MAs fit some pairs better than others, or comparing gold with currency charts from the side of which MA fit which chart? Yes and no. There are going to be some that can be retrofitted to fit a currency pair well, based on how that pair moves on an intraday basis. But the thing about it is that I wouldn't make that a global thing, in the sense of, if a model is usually very good at trading a pair in a time frame, it's probably good on multiple time frames. And so I've found, this is just my personal experience, that the 20 EMA is an incredibly good EMA to use on multiple time frames. If I'm trading the 1 minute time frame, or the 4 hour time frame, or the daily, or the weekly, or the monthly, I always use the 20 EMA, because I've found that it's the most balanced between the two, between all the EMAs out there. That's just my personal experience of it. And so what I would do is, instead of trying to say, okay, I'll use the 20 EMA on this one here, but on this one I use this one here, and then this one here I'll use this one here, unless you're really good at spotting the patterns and variables and things which would cue you into that being true, then I would just try and find one that works best on all of them, and then go from there. So hopefully that answers your question. And AB says 20 EMA, yes, EMA. Okay, fantastic. So I have to get going. I have another meeting after this. I want to thank you all very much for coming. And then I'm getting on a plane and flying another 7,000 miles. It's crazy again, but I'm doing it again. Anyway, so I bid you all adieu. I wish you all good luck trading, good price action trading this week. If you have any questions about what I do, feel free to check us out, secondskiesforex.com. And if you have any questions, feel free to email me, info@secondskies.com. Until then, good luck trading. Thanks to FX for hosting us. I wish you all good luck, and I'll see you next week. Take care, everyone.